Little bit of deja vu at this press conference. Last year, you were also talking about recovery in revenues. Are you more confident that 2018 is your year, and what kind of shape do you expect the recovery to take?
I am more confident this year than last year. Although it's fair to say I don't think any bank anticipated what happened in the trading markets last year, where it turns out, although we're very disappointed with the year-on-year and the quarter-on-quarter revenue shift, we seem to have gained some market share, which is perhaps reflective of the fact that we are on this recovery phase. Right now, though, I think that there has probably not been as good a time to be in banking in the three main economic blocks, because the macroeconomic backdrop is marvelous. I think client activity levels are picking up, much more so, I think, on the corporate side than on the institutional side. But there are some drivers on the institutional side. Particularly, we're still looking forward to euro rates going positive again, which I think will drive a lot of activity.
Nonetheless, shareholders have expressed great concern today, at least by the look of the price and the markets. Do you feel like you're in a race against time in some sense, or do you feel you still have the full support of your biggest owners?
I don't particularly personally feel the pressure from the shareholders. I feel the pressure from ourselves. And to the extent we're in a race against time, I actually think it's against technology.
And how do you mean that?
I think that the banking world, particularly retail banking, and I think some of the way that markets trade are changing so rapidly by external factors, external fantastic new technology companies coming in and disintermediating, that what we need to look out for is the real competition that we don't see. We obsess with our peers, but I think the competition comes from other places. And that's why we're so determined to invest as rapidly as we can in technology. That's why I'm personally slightly less concerned about the cost targets. Of course, we have 100% commitment to managing the costs, but it cannot be at the expense of cutting back on investment, because to secure the long-term future of the bank, we really do need to keep up, particularly with technology investments, but also making sure we've got the right people.
With regards to the cost targets, one of the reasons, or the main reason that you're going to have to push those out is that you didn't dispose of, I think, 900 million euros in assets on time.
It's 900 million euros worth of costs and a similar amount of revenues. So these are businesses that don't really make much of a contribution, and they're really not. They're not core to what Deutsche Bank is.
Does the asset management IPO fall under that umbrella?
No.
Because in November,
no.
In London in November, you said that you hope to get that done by the first quarter. Do you still think you're going to stay on schedule with that?
Well, I'm not allowed to say, because when you're in these securities laws worlds, you have to be very careful about what you say. We've made great progress. We're not quite there yet. Few I's to dot, T's to cross. But we're almost there, and I think the markets are in great shape. So my view is we take the first available window once we're absolutely ready.
One of the interesting comments you made during the press conference was that you wouldn't rule out a merger, you wouldn't rule out a combination. And Christian was talking about his conversations with Berlin and how they want to see a strong German bank. When do you think you will be ready for a merger?
Not very soon. I mean, I think 100% of our focus has to be on remediating what we've got left to do, and then putting the bank in a good shape to grow. And you're right, I did say that. And in years' time, there's no reason why the bank should exclude itself from that type of activity. What I do think is really important, though, is that we continue to invest in technology that lets us grow organically. When I look at the transformation of German retail banking over the past, seriously, 2 or 3 years, we were nearly not digital at all when I took this job. This is not credit, this is a change in the market. To have 11 million of our customers now attaching to us in a digital way is a real sea change in the way that banking is taking place. And the challenge is keeping up with that. And the risk, if you in some future time transact a merger, the risk is that you then spend a couple of years integrating yesterday's business and you miss out on tomorrow's. So I keep telling our team, let's look at tomorrow's technology, tomorrow's way of delivering services and products to clients, and make sure we're there. Otherwise, the big guys from the US or China will be there instead.
Do you hear, though, from Berlin, do you hear from shareholders that they want to see some kind of tie-up?
No. No. No, and I don't think they would ever seek to run our business that way. Whether they would stand in the way, I don't know. At the moment, the company, in my view, isn't ready to do something like that and shouldn't feel itself ready. We've plenty to do, and we've huge opportunity.
One of your big shareholders, HNA, has said it wants to dispose of $16 billion worth of assets in the first half. How have your conversations with HNA been, and is that stake one of the things that you think they'll sell?
I honestly don't know. We've never discussed it with them. Remember, it's a matter of public record. It has, I think now 3 collars around it. So I don't know what their intentions are. Our relationship with them is fine. They've C Quadrat, which is the contracting party on these derivatives, and I think the shareholder, its CEOs on our supervisory board. Great relationship, but I have no sense in any change in their stance.
Finally, with regards to bonuses and remuneration, when I talk to bankers in London, here in Frankfurt, obviously this is one of the things at the front of their minds. And there was a lot of talk in the press conference about how you may have lost some talent because of your previous remuneration models. Do you feel that you're paying competitively now to get the best and brightest on Wall Street?
I think we've shown we can. I mean, we just hired a new global head of equities. You're right that we took a risk last year. It was a measured risk. We didn't award any of the traditional, the part of the bonus that's the individual contribution. We're not being semantic when we call it variable compensation. A lot of this now is almost arithmetically driven. So the compensation world has changed, but paying that plus as opposed to the minus is very important for our people. But I do think that for our best people, we are paying market. We demonstrate that by hiring as well as retaining. But we do the best we can. We have to balance all of the interests of all of our stakeholders. And the variable, the overall compensation for 2017 was always going to be greater than 2016, because in 2016 we didn't award any of these individual bonus type awards.
And 2018 will be bigger than 2017?
I don't know. I was quite clear today to say if the bank performs really well, it can be, but it's got to be really performance related. In 2016 it wasn't, because a lot of people had absolutely stellar years and didn't get paid. In 2017 I think we've actually been erring slightly on the generous side, if I may suggest. Not for everyone, but we've had some outstanding performances. If you look at our credit businesses, they've had as good a year as they've ever had. On some other businesses, we're investing. So we talk about investment for the future. I think we've tried to strike the balance right.